I have to go back. All right, I'm going to be recording this. And unfortunately, part of my information is already done simply because I had no idea, I said, no one's showing up for the class lesson today, but I do need to video record it. So that's what I was doing, video recording it so that you guys can get the information you need. What we're going to be doing today is going to be demonstrating two budgets, the direct materials and the production budget. And also I want to try to introduce the chapter 10 to you. And the reason for that is because we got to keep going. I will do another demonstration. I'm going to video record this demonstration, and that's going to be the cash payments for materials budget, and I'm going to do the cash collections budget. I'm going to do that as a video separately, and then I will send a link for you guys to take a look at that and go through it. This one here is a little bit more straightforward, and it's easier for me to navigate. As you know, Zoom is new to me. And it takes a little while for me to navigate all the things I have to do and what I can do and what I can't do and all that kind of stuff. So I want to make sure that the cash flow, the cash budget is done separately because sometimes it's a little bit more trickier to do. So I'm going to do that in a video, and I will make sure you get that. All right, so what I did, let's first of all take a look at the information provided. I am going to be preparing a production budget. When you're preparing the production budget, you want to be able to find one thing. What you need to know in a production budget is how much do you need to produce. That's all you need. Now, how you get that information, I'm going to go through the process. I'm going to explain the numbers that I put in here. And again, I apologize that I didn't get to the right classroom. And also, I had to do all the numbers first. But nevertheless, I'll show you how the numbers are derived. If we are going to try to figure out through estimation how many units we want to produce, we need to gather some specific data. The first thing we need to know is the unit sales. And that number is calculated based on the sales budget. But in this example, the sales budget is not done, so it's given to us. So we are given 3,400, 3,800, 3,300. And you can see in this icon here, these are the budget numbers for the number of units sold, okay? But normally with the master budget, you will be computing the planners that you want to be sold, you'll be computing the production, you'll be computing the materials that you need based on those numbers, and you'll be also computing the cash flow. But we already have that. So with this first particular budget, I was able to compute or to put in the number of units for each month and then a total. The same is true here, desired ending inventory. Now, desired ending inventory is a calculation. Based on the instructions, it says the company wants to have 20% of materials required for the next month's production on hand. And it costs 20, I'm going to minimize this. It costs 20 cents per pound. Hopefully you can see the entire screen. With that in mind, what I had to do was I had to take and determine, and I'm going to show how I calculated. So I'm going to change to an Excel spreadsheet. So give me a second. And I'm going to share my Excel spreadsheet. And I suggest you do it this way as well. It makes creating this particular part of the budget a little easier to understand. What I did was I took all the months that were given, the next month's unit sales, and the percentage of desired inventory. That's given to you. And all I did was I multiplied these two together. So when it's asking you what is your desired ending inventory, this is the calculation that you'll need to make. So for the 950, I took 25% of the 3,800 units for January, next month's ending inventory. And the same with the 3,300 and the 4,900. To give me 950, 825, and 1,225. Now I'm going to go back to my class assignment again. And that's how I derived the 950, 825, and 225. Now that we have our unit sales, we want to add to that the number of units that we want to be our desired inventory to come up with our total number of units that we need. In this case, 4,350, 4,625, and 4,525. The next step is, what is our beginning inventory? Now, this is important to know. So for the first month, our beginning inventory is told to us. Start of the year is 850, and that's the number I placed here. However, what's going to be the next number is going to be something you think through. The next number is going to be the beginning balance of, or the ending balance of the last month. And in this case, we're in February, the beginning balance, inventory balance, is going to be the ending of the prior month, if that makes sense at all. So the number I placed here in this column here is 950, because that's the ending inventory for January and the beginning inventory for February. And then for March, I did the exact same thing. I took the 825 because it was the ending inventory for February, and it's the beginning inventory for March. Now, and that's all we need to do. From that point on, we just do our subtraction, the difference between our beginning inventory and what we need. That's going to be the units that we need to produce for each and every month. With that information in mind, however, what we need to do then is now complete our direct materials, because we know how many units we need. Now we need to know how much of the materials that we need to purchase. So in this case, I just took the 3,500, the 3,675, and the 3,700 units, and I plugged them right here because that's all we need. We've already calculated that. Now in the instructions up on above, it says here, it says, let's look. The company has a 20% P required for the next production on hand. The units are 20 cents per pound. And then it's give you some other information. Let's see how much it costs us. Each planter is 3 pounds of plastic each. So I'm going to need that information, okay? So what I want to do is, how much do we need? We need 3 for each one, and I put 3 in each one of these. Now what we need to do is calculate a multiplication. I'm going to get my document here. If I multiply 3 times 3,500, I get 10.5. I'm going to do the same thing, 3 times 3,675, and I get 11.25. And then for here, I get 11,100. Not bad at all. That's all you need to do. Now, when we have the desired inventory, the desired ending inventory of direct materials, where does that number come from? Now, desired ending inventory, that is going to be another calculation that we'll have to do. Now, if we want to know what our desired ending inventory is, I think I might be able to do this on the screen. I'm not sure. It's kind of hard to do with this. The desired ending inventory is going to be the next month's unit sales multiplied times 25%. So in this case, we want to take our desired ending inventory. Now, if we look at this number here, what is going to be our desired ending inventory? What information we're going to put in here? It says here, desired inventory of planters at the end is going to be 25% of the next month's budgeted sales. So if the budgeted sales is 36.75, I believe, let's see, for February 8. I'm using my calculator. All right, so let's take my calculator and we're going to multiply . And we've got, let's see, go back to this here. Our next month's production. So what's going to be our next month's production for our inventory? And that's going to be 11,025. Now, I need you guys to chime in if you don't understand. We want to put the ending inventory in this field, but we have to go to look at the next month, and we're going to ignore this one. We're going to be looking at the 11,025. If that makes any sense, because that's what the instruction tells us. So I'm going to use that 11,025, and I'm going to multiply that time what it tells me, which is 0.2. 0, because it tells me that it costs 20 cents per pound. I'm moving very slowly here because this is where most people kind of get tripped. The first thing we have to think about, guys, is the base that we're going to be using is the next month desired ending inventory. In this case, February is going to be the number I use for January, and March is going to be the one I use for February, and April is what I'm going to use for March. So far, so good. Now, what we multiplied this 11,025 with is the cost. In this case, it's 0.20. So I'm going to take my 11 and multiply by 0.20. And I get 2205. Now, the next month, I'm doing the exact same thing. I'm going to multiply that number by 0.20, but the question is what number I'm going to multiply by. And it's going to be the 11,100. So 11,100 multiplied times 0.20 is going to give me 2220. Now, the next number I'm going to do is for March. Now, right now, I don't see where's the next month for March. Well, if you click onto additional information, March is going to be using April's number. And how do we get April's number? Now, this is what I'm going to do, okay? So just don't worry. I'm going to do the same thing. I'm going to calculate the desired ending inventory for April. So what I'm going to do is I'm going to come out of here. I'm going to do the exact same thing. I'm going to stop sharing this screen, and I'm going to share my Excel spreadsheet so that we can do that. Now, here is April. Oh, I actually did it already, but let's think about that. Now, we want to know the desired ending inventory. We want to know the quantity needed for production for April because we're not given that. So if we got unit sales of 4,900 for April, this is all for April because we need this information. Unit sales is 4,900. Now, the desired inventory, we have to take and consider the next month unit sales of 4,600, which is given to us in our process. And we're going to multiply that times 25%. So our desired ending inventory, this one is a little bit more involved. And I'm going to take that, which is going to be 4,600 units multiplied times 25%. And I'm going to subtract, or actually I'm going to add the two together. And I'm doing the same thing for this particular month that I did for the 3 other months. And now I'm going to take out the ending inventory, or the beginning inventory I was given. And the beginning inventory is 1225, which is this one here. So I'm going to take that out, 1225. We calculated that. And now I can take inside what is my units to produce for April. I know this sounds kind of strange, but we have to calculate that. So now I know my units to produce, but I need to also consider the cost. So I'm going to take the two and multiply them together. Oopsie. Now let me plug in these figures here so you can see what I've done. Here's my desired ending inventory. And from there, this gives me the units to produce. This is going to be my desired ending inventory. Gosh, okay. This is my beginning inventory. Okay, I start with my unit sales is 4,900. I have my beginning inventory. To add the two together, I come up with my units to produce. I've already calculated here my ending inventory, my desired ending inventory, so I'm going to put that there. And this gives me my units to produce. Now, this is going to be the cost for the plastic. Hopefully this works. Yes. And by multiplying these two together, I come up with 14,475, which is going to be my quantity needed for production. Quantity for production. And we did this already for the 3 months, but because we need to have this information for March, we had to go through and calculate. So now at that point, I know it's 14,475. So I can stop sharing this screen and go back to the assignment and plug in the 14,475. Oh, I'm sorry. Design, let's get that number first. 2895, let's see, hold on just a second. There's a calculation I didn't put on here. Oh, right, the 1475, but what I need to do with that 14,475 is multiply times, I believe the instruction said it's 20 cents per pound. So let me multiply that by 0.20. So 14,475 times 0.20, 2895 is my number. All right, now let me talk about this for a second before I go any further. Because we are taking the next month and using the ending inventory, when we're dealing with March, we have to go to April, but we need to go back to April and compute all of this. So what I did on the Excel spreadsheet was make the calculation for April as if I was asked for April. So I did January, February, March, but because I need to have the desired ending inventory of direct materials for March using April's information, I had to go back and go through calculating what are my materials I needed, what would be my beginning inventory and my units to produce. Then I was able to compute the desired ending inventory for the month of March. That was the only reason why I had to do that, because it was asking me for the next month's sales. Okay, so now that we have our desired ending inventory, we've calculated that. This is a simple math problem by taking the difference or adding these two together to come up with our quantity that we need. So I'm going to say, if I add a 10,500 and I add that to 2205 and so on, I get my units in terms of quantity that I need to produce. Oops. I would say, and this is one of those situations where you have to think about, and to put the quarterly numbers in. Put the quarterly numbers here, just so when I calculate all of this, it works. Oops, 35,520. Okay. So I think what makes this particular problem a little bit more work is calculating the desired ending inventory. And my suggestion would be to just take a little spreadsheet and put the numbers side by side and make it easier to follow. And the reason is because with this particular transaction, it's always looking to the next month of what our desired inventory might be. So when we calculated these numbers here, when we actually put these numbers together, for example, if I'm looking to know in March what I'm going to estimate, I need the April's numbers, which is why I had to go through this entire process again for the month of April in order to calculate what the desired ending inventory is. But the calculation itself is not all that difficult. All we're doing is just considering our unit sales, what we believe our desired ending inventory should be. Again, it's going to tell you what the percentage is. The question then becomes, what number do you multiply that percentage by? In this case, 25% times the next month's budgeted sales, for example, in units. So, and then once we do that, our beginning inventory for the first month is given to us because we use this number here. But for the months prior to that, we have to remember if our beginning inventory for February has to be the ending inventory for January, and our beginning inventory for February has to be the for March has to be the ending inventory for February, and so forth. And that's how these numbers come up. You don't have to calculate anything, just use the numbers here. The only calculation really comes in when you have to calculate what the total quantity is needed, in which case has to tell you that you're gonna need 3 pounds for every unit. So by doing the multiplication here, you're taking 3 pounds for 3,500 units gives you 10,500 that you'll need, and so forth. So the calculations in this particular example, I would say the calculation for the desired ending inventory would be probably I would say the most cumbersome to compute. And using the little Excel spreadsheet very, very quickly kind of gives you an idea of how to calculate it and do it without any error. That's just my suggestion here. Now, with this budget, it makes sense only when you look at it in light of the budget that we just prepared provided us information on what we're going to produce and the cost of what we're going to produce in terms of material. The next step will possibly be whether or not we create a cash flow budget and how do we spend that money and do we have enough money. So the question is, how many units do we need to produce? How much is it going to cost us in direct materials to produce it? That's the only question, the only answers that these two budgets provide us. And that's fine. And that's perfectly fine. The most important thing is using the budget, knowing what the budget tells you, and not trying to get more information than what it is actually intended to give you. This is all it's giving you. You'll need to know other types of things, like if you do have enough money to budget for this. Do I have enough inventory? Do I have excess or idle inventory to do this? Those are different questions. Or are my sales in line with what I'm projecting? Again, another budget. The most important thing is knowing the budget is, knowing how to compute the information, and knowing what it provides you. All I want to know is how many units I want to produce, assuming some scenarios, and how much it's going to cost me in direct materials. That's all these two budgets give you. That's it. Your project is going to be looking at the entire, but I had hoped that you guys would do the individual budgets first to get practice and understand what information you need before jumping into doing the entire production or the entire master budget. Again, a master budget comprises of a sales budget, a production budget, a direct materials budget, cash collections budget, capital expenditures budget, and then also cash used or cash needed. I think what it's called. Cash used or cash needed for your direct materials. Those budgets all together gives you a master budget. And that's what we're trying to get you to do, is just to see what these budgets mean and then how to use them. But then in total, what kind of picture does the master budget give you? Okay. Now, this is where I think we should stop, because I really don't want to overwhelm you with the budgets. Just take the time to go through this particular video again, and just remember what information you need. When you're looking at the instructions on these budgets, it's going to give you a lot of information. And my suggestion is you only need certain bits of information depending on what budget you're creating. Don't become overwhelmed by all the data. It's a lot of data in each one of these little assignments that we're giving you. But you only need some specific type of information. You only need your number of sales. You only need to know what's your desired ending inventory, what's your beginning inventory, and the new unit sales. And then you may want to know what is going to be the percentage of your sales. That's all you need for your production budget. But then for your direct materials budget, you need to know how much it costs. You need to know how much you need per unit in terms of material. And you need to know and calculate your desired ending inventory. So it's 3 bits of information. So when you're going through and trying to create this budget, remember, those are the 3 things you need. Everything else you can put to the side and use for another budget, but those are the 3 things you'll need for that budget. And that, I think, will help you organize the data. And the next suggestion is, when you're calculating, particularly your desired ending inventory, or in some cases your cash needed, or your cash flow from accounts receivable, when you do your cash flow budget, it does become helpful, I have to say. It becomes quite helpful to create a little spreadsheet like I have here. And I'm going to stop here and just give you an idea of how important or useful the spreadsheets can be when you're trying to calculate numbers. I mean, you can do it on your iPhone, etc. But when I organize the information like this, I can actually see what I'm trying to the calculus I'm trying to create, and it makes a little bit more sense to me. So I would suggest using that type of thing as you're calculating various numbers. And I did it here because I wanted to kind of give you an idea, and I can also share this with you. It's just a little tool that will make creating the budget a little bit easier, particularly when you're trying to plug information into your spreadsheet. The other thing is printing everything out, I think is important too. When I'm working on this particular assignment, I had to print it out because I wanted to make sure I can look at it like this and write on it to get the information that I needed. And let me go back to the classwork assignment. So these are just two of the budgets that you will be creating. You will be creating at least 5 of them in various different examples. And I don't want to do too much today, but I think I've given you enough to get started. The sales budget is quite straightforward. It's going to tell you the number of units for the first period, and what your job is to multiply through. For example, it's going to tell you that your 850 planners that they're going to sell the first year, and then 20% more the next year or the next month, and then 20% on the next month. It's just a straight out calculation of the number of units, giving you the amount of the sales price. So the sales price multiplied by the units gives you your sales budget. Very, very straightforward. So reading the instructions will be quite important. Just make certain that you calculate the right amount of units that you're going to be selling each month based on the sales price. And so that's not too difficult a budget to prepare. Any questions about what I've reviewed so far? You can use both your chat or you can use your audio. Any questions? Okay. All right. I'm not getting any questions, so I'm hoping that everything is all right. Let me see. Let's stop share. Okay. Now, the next thing that we have to do, again, the budget, the master budget is a part of your grade, and I think you're going to enjoy doing it. I think you're going to be useful in helping you. I think the next thing we're going to do is not get behind. The next chapter that you will be working on, and you're going to be working on that all next week. Okay, let's go over what we're going to do next week. Next week, I'm going to finish chapter 9, and I will review with a classwork activity, and we'll do some questions on that. Then we're going to jump right into chapter 10. Chapter 10 is about performance evaluation. And then what I don't like about the chapter and how they're set up is, my personal opinion would be variances and standard costs should come immediately after budgets. But for some reason, chapter 10 is going to be talking about performance evaluations and all of that. So that's not too difficult a chapter to get through, but I think it seems to be out of sync with the logical flow of what we've been doing. So we're going to talk about chapter 10 today really quickly, go over what you'll need to read and what you'll need to gain from that chapter. I'm going to submit to you guys a video going through details of how to create a cash budget and also a direct materials or cash needed for direct materials budget. Help you get through those, and I will do that in the video. My suggestion would be to watch it over and over again as you're doing your homework, as you're doing your project. And then after that, on Tuesday, I'm going to review chapter 10 in terms of calculations. I'm just going to take 5 or 6 problems, multiple choice problems, and go over those with you. Hopefully by then you would have read the chapter and have some questions about that. So far, so good. I'm hoping everything's okay. Very, very quiet. All right, let me talk about chapter 10 and what I think you will be needed. Chapter 10 is about a performance evaluation. Remember, everybody knows what a performance evaluation is. I work for a company, and every 6 months I get an evaluation of how well I do my job. Do I follow the standards? The standards for my job could be supervising my staff, providing useful tools to board members, calculating, doing my job. Each one of those major criteria of what I need to do my job. Well, the same is true for performance. Organizations do have managers, and they're held accountable for their job. They're held accountable for the work that they do, the sales that they produce, the individual projects that they are able to acquire if they're in marketing and sales, how many new jobs, how many new clients that you get. That's a part of their performance. Well, organizations can be centralized or decentralized. I think in government, it's a kind of combination of the two, but a centralized organization is one big unit and everybody falls underneath that unit and they all work kind of in tandem. Decentralization is more autonomous, meaning each department has their own structure and their own layout, and they work almost independently, but also together as a unit. So decentralized or centralized operations. Organizations have to determine if they're going to take a project on and how to evaluate that project. So they'll calculate the return on investment. They want to talk about the turnover. They're going to talk about their margins. And they're going to also talk about how to use a flexible budget. Remember, we know what a budget is. And the budget that you guys have been working on for the past couple of days have been, I would call, static budgets. And why do I say a static budget? A static budget doesn't change. These are the first 3 months of our quarter. These are the budgets for these first 3 months, and that's it. We're going to talk about a flexible budget and what that is. And you can take and contrast or compare what the differences are based on what you've read so far. So companies that split their operations into different management segments and so forth, that is very, very common today. And they do it by space or where you were located, by product line, etc. Kellogg's is decentralized. It just is. And they do it based on product line, as a matter of fact. They, with each of one of their products, and they have a lot of those products, and they do it segment by segment. How do we actually manage and oversee and evaluate performance? We do it based on our products. But you could talk about organizations that do it by geographical area. And retail is definitely like that. They most certainly want to see how well they're doing in the markets in New York and the markets in California and the markets in Pennsylvania, based on where they're located, and which is why you can see there are a lot more targets in certain areas and a lot less in certain areas, because based on their analysis and their performance and their return on investment, these markets in these different areas may not necessarily be the most profitable for us. And we want to make certain that we have our products in locations where customers can and will go out and get those products. But they can do it based on their customer base or their function. But I would say the first three are the most common: geographic location, the product itself, or how that product is distributed. How they can distribute the products, how can they get their products to you, the customer. And those are the most important ones, really, I think, and they're mostly used. The advantage of those are clear. This chapter has some computations, but it's really about conceptual, the concepts, a lot of concepts in here. Why we're using decentralized versus why we don't. And again, there's a possibility of duplication of efforts, which can be very, very expensive. So they have to consider that. That's going to be one of those things they consider. But it also allows organizations to tap into their staff and their individuals with their knowledge base. And customer service, again, when you have a location that could do everything to help a particular customer, you're going to win. You're not going to farm them off to California or to New York. You're going to be right there with them, giving them what they need and helping them with their problems or with their needs. So customer relations always is helpful and always in very much an advantage. So they want feedback. That's what an evaluation is. It's telling us what we've done right and wrong. It's not positive feedback. It's not negative. It's the whole. How well did we do? Did we meet our expectations? Did we not? And why? So providing benchmarks allows you to do that. And this is kind of something that you're going to be talking about when you're doing your standard variances and your standard cost variances, because once you identify a variance, your job is to drill down and determine why there is a variance and what that impact is. As management accountants, that's what they do. So clearly showing what their expectations are, giving them some kind of measurement tool, which is called a benchmark, and also motivating them. I mean, if you're doing very well, that could very well be part of your compensation package. You might get a bonus for that. You might have a cost share agreement. So the better your organizational structure or whatever your area of focus is, you might get a piece of that revenue. So that's kind of important part of motivating people to do well. So for responsibility accounting, again, there's a lot of concepts here and a lot of terms, not too hard, but just remember there are a lot of them in this chapter. As part of the organizations for planning, accounting is going to be evaluating it. And that's going to be something that I will be doing, evaluating what people do, how they do it, using budgets as a tool. So cost center, revenue center, profit center. Again, revenue center is where the actual revenue is generated. Cost center is going to be where they are actually manufacturing the products. You know, you're talking about Kellogg's. Kellogg's is going to be their cost center is going to be their manufacturing plant and all of the materials that they need to do that. And then with the investment center, again, I would say how they use their money, excess money particularly, how they invest it to help that organization grow. And the profit center is going to be, you know, on how they generate that income and how they control their costs. So these particular cost centers actually work very much in tandem with one another. This is very much a organizational chart. I would say using this chart, just get familiar, if you will, with what an investment center is. Get familiar, if you will, what a profit center is, for purposes of maybe a question or two might hit on a multiple choice question. But performance reports is the key here, and how they look can vary. You know, but the most important thing is comparing what you've done, what you think you're going to do, comparing what actual against your budget. And I had mentioned before, budgets are for purposes of allowing you to plan, but it's useless if you don't measure it against what reality is. You have to use that budget as a tool to guide you. It allows you to compare what you've done and determine if what you thought you're going to do, your budget compares in a positive way to what you actually have done. So taking the difference between budget and actual is called the variance. And we're going to talk about that a whole lot in chapter 11. This is giving you a good introduction. So the variance is going to be what is good, you know, it's a favorable variance. It's your income is higher. Say, for example, you have a revenue that you budget of $1 million, but you actual was 1.2 million. That $200,000 difference or variance is a positive or a favorable variance. Or you budgeted $1 million, but you only received in revenues of 900,000. That $100,000 variance is an unfavorable one. And the job of these performance managers is to determine why the variance was unfavorable and why the variance was favorable. We don't want to just know if it's good, you know, if it's bad, why did it occur? We want to know what we're doing good as well, so we can repeat those kind of actions. We can repeat that kind of analysis when we're preparing our budget. Management by exception, they investigate budget variances that are relatively large. Organizations are going to be concerned with materiality. If it's material, we're going to investigate it and make the appropriate changes, particularly if it's unfavorable. That's all it is saying. Now, this is just an example, and I think this is one of the slideshows that I really would like for you guys to print and keep on your wall, because it does give you a lot of information. You are going to be looking at your sales budget. And in this case, the sales budget is by product, which is extremely good. This is, again, Sun Chips, which I have had before, which is very good. Frito-Lay, Tortillas, Cheetos, Fritos, Doritos. I don't know about you, but I've had them before and they're very, very good. Now, they can project what they think their sales in dollars is going to be. They can do the same kind of projection in units. You don't have to do it in budgeted dollars. And the number of units of chips that we sold is the equivalent of 2.4 million, whatever. So in the budget, what you're trying to do is you're going to be calculating the difference between what you expect, which is called your budget, what actually occurred, which is your actual sales, and determine what that difference is. It's a basic subtraction. What is the difference between reality and fantasy. And I call a budget fantasy because it's not real. It's not real. Budgets are not real. Now, don't get me wrong. Budgets should be based on logical and realistic expectations. But the reality is that it's not real. Don't think your budget is 100% accurate. It's not. It never will be. Budgets are not like that. They're tools. And if they're formulated well and a variance does occur, it's nothing to do with the budget itself. It's to do with what has occurred in that month or year or 6-month period that was unanticipated, that you couldn't anticipate, that created this variance. And you can see side by side, the variances are in a mixture of favorable and unfavorable. But notice also at the bottom here, you see this 1.2 million. It should very well be the equivalent of the difference between the 4.47 million and the 45 million. And overall, they're doing favorable by 2.71%. But if you're a management accountant, you want to know the minutia. You want to know product by product, which product is giving me the most difficulty. And it looks to me that Sun Chips and Tostitos, which I like, quite frankly, I like them a lot, but to be honest, but that's just me. On this spreadsheet here, those two product lines are not doing very well. And if you're a manager of that particular product line, your job is to investigate why the sales are lower than expected. That's basically what it is. Why are my sales lower? Segment margin reports are going to be the contribution margin, which we already know what that is. And we're going to talk about what those differences are, how to separate our fixed costs and our common fixed costs. And again, these are a lot more terms, not difficult, but they are related to each other. Just remember what the terms are and what they mean and how to apply them. That's it. And here we're talking, again, using the sales or contribution margin financial statement. Again, you know what a contribution margin looks like. The only difference between the contribution margin that we've used in the past and the one we're using in this chapter is that it has a column called variance or budgeted / variance. That's all the difference, because all the information is the same. All we're doing now is comparing how much we expect or how much would really happen and calculating the difference in dollars and in percent. And if you can look at this number, I believe, I'm going to look at this, the calculation is going to be this number here, which I think is D5, and dividing it into the total contribution margin. And that's what I'm giving, that's giving us our 0.3. Get what I'm saying? So we divide 14 into 3, the 13, we're getting our variance in percent. Or you could do the 4,300 divided into our contribution margin. Either way, it gives you the same thing. All we're doing is finding out what is our variance in dollars and what is our variance in percent. So on dollars, you're going to subtract the 2. In percent, you're just going to divide through. 4,300 divided into the total, 1,700 divided into the total. That's all you're doing. Very, very basic computation. And again, I think it's easy to follow this when you're taking, when you're using it within a Excel spreadsheet. You can see the calculations a little more clearly. But again, you need to know that because you're going to see questions asked of you. You know, what's the variance in percent? What's the variance in dollars? And what is the standard cost variance? What is the, you get what I'm saying? So these computations, although they seem simple, are going to become extremely voluminous. You're going to have a lot of very nitpicky kind of computations of different variances that you'll need to remember in these chapters that follow. Chapter 11 in particular. Return on investment. Again, if you're going to make a purchase of a long-lived asset, or you want to be able to measure how long it takes you to recover from the money that you spent, that's your return. And that's an important piece as well. I think it's all used in tandem to allow individuals and organizational leaders to make decisions, long-term decisions, but also very, very quick or short-term decisions. And again, it has to be looked at in totality and not in isolation, which I think is really important. You really got to look at the whole picture and not the little various pieces of that picture. The various pieces are very important, but the whole scheme of things have to always be the foundation of what you're doing and when you're evaluating it. And again, this is a computation that you can remember. Don't worry about it. It's gonna be on your cheat sheet. Return on investment is gonna be your operating income divided by your assets. How are you using your assets to generate revenue for the firm? Period. That's all it's doing. How many times it takes you to turn it over is another calculation that organizations do, will perform. So a big number is going to be positive, a lower number. And a big number on its own makes no difference. You have to benchmark the number. That number should be compared with, if we're talking about Pepsi Cola or a company like that, why not compare your ratio with another organization that produces the same type of products or similar products and benchmark that? Because in isolation, it may not be as good as you may think. Because if you benchmark it with a competitor, you might say, oh my goodness, we're doing okay, but they're doing even better. We need to know what they're doing. So make certain that you're using benchmarking in the right way. Don't let it be overly negative. Put it in perspective. Benchmark it with another organization of similar size and similar product line. And that will put everything in perspective. So again, the calculation is not all that difficult to do. The main thing is using it in the right way and interpreting the information to make an effective business decision. So capital, again, whenever they're talking about capital, they're talking about long-lived assets, okay? Capital is going to be the machinery that they use. Hopefully, I didn't have a break in my communication, but the main thing is long-lived assets. We are talking about assets that are going to be around for 1, 2, 3, 5 years, and we want to see how quickly we turn it over. We want to make certain that each one of our snacks in our division, how well are we doing? So using that as a base. Again, residual income. Residual income is what's left over, okay? What's excess beyond management expectations? What do we have excess? Residual is what's left over, and we want to have as much as we can. And organizations usually look at that every single year. What's going to be our residual income for next year? And we always we evaluate, did we meet our target? And why didn't we meet our target? That sort of thing. This chapter is all about finding ways to evaluate performance and various measures. And in essence, here are all the ratios or the calculation measures that you'll be looking at throughout this chapter. They're not anything difficult. And in fact, I think they may have been covered in Principles 1, I think. But we're going to talk about these more in chapters 15. I'm trying to remember. Chapter 15 of this book, we're going to talk about financial statement ratios and analysis. And all of these calculations are going to be part of that. Just letting you know, they are setting you up for more information and more analysis, management analysis. So you're going to see probably 15 more ratios that you'll have to calculate when you're evaluating a financial statement. So just giving you a heads up, you're going to be talking about these for quite a bit for the rest of the term. So with this chapter, I would say the most important thing that you need to get out of it is managers have tools in their arsenal to evaluate performance. How do we evaluate performance? We use budgets and we use ratios and benchmarks to do that. Organizations may be centralized or decentralized in their performance of their duties. Decentralized organizations are not as prevalent as decentralized, where they group their operations by geographic location, by product line, or by the segment of customers that they are trying to reach. Nevertheless, they are going to be providing performance measures to make certain that they are able to compete in the marketplace. They do that using variance analysis. How do they do that? They compare with their actual versus their budgeted, and they identify favorable and unfavorable variances, and they drill down in some cases to determine whether or not action needs to be made. When they make that determination based on the materiality of those problems, material means the bigger it is. How big is this unfavorable variance? And again, I evaluate unfavorable variance all the time. And when they're immaterial, I will say that this is not worth the effort. It's immaterial. We'll see if it flushes itself out in the next quarter. Simple as that. But if it is material, it could be an indication of a downward trend, which management has to investigate. Can we use up all our assets? Are we using up all our assets? What is going to be the adjustments on income that we may need to make? How should we use our balance sheet to help us guide the future performance? Again, sometimes being short-term and its focus is kind of a downside. But when you're talking about a very quick market, right now, very, very quick market. Short term is not all that bad. Quite frankly, it's going to be the mainstay because we're talking about a pandemic here, and many organizations are dealing with massive layoffs, massive changes in their sales, and they have to have a short-term focus. They can't think long-term because nobody knows what's going to happen long-term. Nobody can even guess. So right now, they are really limited. What can we do right now to stay afloat? What can we do to manage this crisis? We are going to experience some unfavorable variances in our sales. We know this. We're not surprised. It's going to happen. The problem then becomes, what can we do in the short term? So don't get me wrong. Long-term projections are good, but they're not as accurate. The longer you project out, the more unlikely that your projection is going to be accurate. The shorter the projection, the more accurate it is. So although this textbook tells you it's the performance evaluation has a limitation because of a short-term focus, I'm thinking I don't have a problem with that because my numbers are very much reliable. Long-term, it gets less and less reliable the longer the projection goes out to the future. That's just my experience. So again, organizations and transfer pricing, I have not experienced this, but understand what transfer pricing is, how it affects operating income and sales margin, and also why an organization would use transfer pricing. Why do they feel that they need to transfer price? Under what circumstance? That's really what I would say for all of you to get out of that chapter. And again, looking at this particular spreadsheet here, you might want to look at the advantages and disadvantages so that you can be able to answer a question or two in your multiple choice assignment. But I don't foresee using transfer pricing as a big part of this chapter. I think the most important is going to know how to calculate the return on investment, understand variances and why some variances are favorable and what would make a variance favorable, and how to calculate a variance, both in dollars and in percentage. That's far more important than transfer pricing. So just take that consideration as you're going through. Now, again, global considerations, we're talking everything that we can get it internationally. It's just the way it is with the internet, the market, and so forth. Getting products from another countries is common, and it's going to be common forever. This is the way it is. So we have to consider what the impact of our products in our geographic location and what kind of consideration we need to make on the global scale. How would it happen? What kind of things would affect our organization if we decide to extend our services or products outside of the United States? And again, it's all about taxes, all about tariffs and all those kinds of considerations. Again, this is just another part of understanding how to use the global aspect of our business and the things that you have to consider if you want to take your organization outside of the United States. Tariffs are a big deal. Taxes is a big deal. And it could very well be your cost. Why many times the cost of a product that you buy from the UK, for example, costs more than the same product you buy within the United States. Because we got to deal with the tariffs and they have to add those costs on. Now, do you want to pay the extra money for it? Maybe you do. If the product has the kind of quality that you love and you need, you may pay the extra $2, $3, $4, $5, $10 for it. But again, that's just a personal preference and why the costs are so different. And the same could be true when someone on the UK buys one of our products. We do charge tariffs, believe it or not. We don't call them tariffs, we call them taxes and freight and all kinds of things, but we do charge fees for that. So their products that they buy from us may very well be much more expensive. So they have to consider as a consumer whether or not to buy our products. And we as a provider of that product or service, we have to consider whether or not it's worth it for us. That's what I mean by globalization. Preparing a flexible budget. Now, a flexible budget is prepared different because it's really going to be, we're going to assume certain things, but we can change it. We can change the budget. We can change the assumptions, and it's not fixed. So the master budget variance is one thing, but a flexible budget is a budget that we can change, a budget that is flexible to change. And that's what makes it different. And that's why I think the flexible budget is more commonly used, particularly when you're talking about markets that are going in flux right now. Crazy. they need a flexible budget. A static budget is not going to be appropriate because nothing that is normal is occurring right now. A static budget will give you total misleading results. So that's why. So here is our master budget performance report. And again, it's more or less like an income statement. In my opinion, it's an income statement, but it has a little bit more detail, as you can see, with the variable expenses being delineated and the fixed expenses being delineated with that. And again, your job is to know how to compute the variance and how to compute it in dollars and in percentage. That's what your goal would be in this case, because everything else you already know how to do. It's just a question of what makes it different. Now, here's a copy of a flexible budget. And what makes it different is it changes. It changes. And that's why I think this budget is far more effective when you're talking about a market volatility and a lot of uncertainty. Flexible budgets seem to work. So a volume variances, again, there are terms that you'll need to know. What's a volume variance and how it's calculated. And again, this is the introduction. You're going to talk about this much, much more in chapter 11 and in 12. So don't worry. I would say, first of all, get the definition in your head and understand what it means, because we're going to be using this knowledge in the next chapter, and we're going to also use it in the chapter that follows. Is you have been introduced to a lot of different things in this chapter, so use it as such, as a foundation. Read through the chapter, highlight those different terms that you are not familiar with, flexible budget variance and volume variances, because it's all going to come back to get you if you don't in chapter 11. And here is an example of what it looks like. Again, what makes a flexible budget different? How do you calculate your volume variances? And here is one, I think, you really should print this one out, I think, because it's not something that comes easy in your mind. It's something that's going to be a little bit more, I need to know this by sight kind of thing. So this is another spreadsheet I think you should print out and keep and use it when you're working on your assignments. How do I calculate my master budget variance? How do I calculate my sales commission variances? And how does it affect the master budget? Again, this is just another many types of calculations that are not very hard, but you still need to know how to do them, and you need to know how to apply them. So now, investigating variances. Again, if you're managing by exception, if it's material, and your organization will tell you what's material. If you're talking about a $2.3 billion organization, a $5,000 variance is not material at all. And in fact, they may say your variance that requires investigation has to be 10% of sales, 5% of operating expenses, however they decide to make that determination, so that you can say anything that's way under that, I'm going to note it mentally, but I'm not going to do anything about it. I'm not going to investigate it until it reaches that threshold. How, and management reports, this helps you understand how the decisions are affected, what kinds of decisions that they made and how it's affecting it, those decisions. What is the output? This is the decision you made, and this is what the impact is. Is that good or bad? And it will be the question. So, balanced scorecard, I would just read through that part of the chapter. I might go through a couple questions on our homework just so that you can understand the terms there. So your homework will be a lot of, in this chapter, your classwork will be a lot of terms and basic computations. How do I calculate a variance? Calculating a variance in a multiple choice question. What does this word mean? What is this matching this term with this particular description? So that's what I'm going to show you. That's what I'm going to be doing in your classwork activity. And in this section of the chapter, I think the most important thing is understanding the terms, really understanding what the terms are, and then how to differentiate a balanced scorecard from another term within this chapter. So, and then also the perspectives here, I'm not going to heavily grade you on that as well, but it would be helpful to have this information because it will be used a little bit in chapter 11. Just as a foundation, because when you're asking questions and they might just assume that you know certain things, it might be referring back to the balanced scorecard. At least you'll be able to have a frame of reference So don't overly work this part of the chapter. Just understand it at the highest level. What I'm going to do at this point is say to you, all of you, is what you should be working on is finishing chapter 9 with your homework and with your classwork activities. You should begin working on chapter 10 in terms of reading the chapter thoroughly and beginning the classwork. We will have problems to go over for chapters 10. And I'm going to have that in the classwork activity, not at classwork, but online activity. So that would be something very important. I will put the classwork online. Remember, I'm going to put it online within Brightspace, and you work it online and you'll get full credit. I will also have it in a PDF or a Word document. It won't look pretty, okay? It won't look pretty, but it will allow you to print it out and work it on the paper and then key your information into Brightspace. So don't worry, you most certainly will get a printed copy of the classwork for chapter 10. Any more questions about chapter 10? You really need to get into this chapter. This chapter is going to be actually a lot easier to get through as long as you can understand the different types of calculations. You'll be fine. But it's important to note that budgets are going to be bleeding through again in this chapter and also in the next chapter as well. So you really want to make certain you understand what a variance is and how to calculate it and what it tells you, because you'll be asked questions like that. Any other questions about chapter 10? Continue working on your project. I feel free to submit any Excel files to me for me to review. I won't give you the answer, but I certainly will give you clues as to how to find the right answer if something is incorrect. And I will be submitting to you today, probably close of business, a demonstration of how to create the cash budget, cash collections budget, and the cash needed for direct materials budget. So that will be forthcoming today. Any other questions before I let you go? It's 9:30. I don't want to keep you guys too late. If I don't see any questions, I'm going to assume all is well. I will definitely post this online for you guys to use as you need. And any questions at all, send me an email. If it's really if someone else is asking the same question, I'm going to post it online so you guys can take a look at it. Anything else that you might need? Anything that I can do to help you this week? Okay, I'm going to stop recording now.